April 3, India's foreign exchange reserves stood at a healthy $697.1 billion. These are adequate in terms of the standard metrics of reserve adequacy, whether one sees it from the perspective of import cover, we have about 11 months, as has been the case for some time, or whether one looks at it from the perspective of external debt. Overall, therefore, India's external sector indicators remain favorable. Nonetheless, elevated global geopolitical, trade, investment uncertainties require a continuous vigil of the evolving developments. Despite stronger macroeconomic fundamentals, the Indian rupee in the last financial year depreciated more than the average in the previous years. In this regard, let me reiterate, I've said it many times, our exchange rate policy remains unchanged. Specifically, intervention in the foreign exchange market is aimed at smoothing excessive and disruptive volatility without targeting any specific level or band of price for the exchange rate. This is consistent with our long-standing policy of exchange rates being market determined, and we in the RBI stand committed to this policy and would judiciously continue to contain excessive or disruptive volatility to ensure that self-fulfilling expectations do not exacerbate currency movements beyond what is warranted by fundamentals. I shall now be speaking on the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.3 lakh crore rupees since the last MPC meeting. The Walker since then has traded in the lower half of the corridor, except towards end March, which is a yearly phenomenon. Short-term money market rates, especially those of CPs and CDs, commercial paper and certificates of deposit, they remained elevated. GSEC yields remained largely range-bound with a softening bias in February, but thereafter, on account of the ongoing conflict, they hardened, as did the global yields, along with the rise in the energy prices. Transmission in the credit market has remained satisfactory. To ensure sufficient liquidity in the banking system, the Reserve Bank proactively undertook durable and transient liquidity measures. Going ahead, we will continue to be proactive and preemptive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy. As for the financial parameters of the banks and the NBFCs, let me inform all of you that the parameters related to capital adequacy, liquidity, asset quality and profitability of the scheduled commercial banks continue to remain healthy. Similarly, the system level parameters of NBFCs too are sound, with adequate capital and improved GNPA ratios.